All right, everyone. Thanks for joining. My name is Nathan Davis. I'm a partner here at Aspen, as well as our Chief Investment Officer, responsible for our quarterly market updates. Always appreciate those of you who choose to attend live and register with us. Thanks for joining us today. Jim, as always, let me know if as I start advancing these slides if you're not seeing them for any reason. But we'll go ahead and get started on our fourth quarter review of the third quarter market update. So what we're going to discuss today, we'll talk about equity markets, we'll talk about fixed income markets. We'll provide an update on the economy, how that ties into both equity markets and fixed income markets. We are going to close things out talking about investing and elections. In case any of you weren't aware, we have an election coming up here soon. Tends to lead to some very good questions that we get from clients. Very understandable concerns about market volatility around elections. We'll cover a few charts that show what we should be considering, what we should not be considering in investing around elections. And then lastly, as we always try to do, we will close out our presentation with actual implications for investors. Hey, if we talk about all of this data, we review all of these charts, how is that actually going to impact you as investors when it comes to managing your asset allocation considerations, your overall portfolio management considerations? That's what we'll close things out today. We always like to remind everyone that while we will talk a lot about what has happened from a markets perspective and economic data perspective, we'll talk a little bit about what we think might happen or what some possible outcomes are for markets, for the economy going forward. We definitely don't believe in a philosophy of guessing what's going to happen in markets, guessing what's going to happen in the economy, and making changes to our portfolio constantly because of that. For our investment philosophy, we believe in a disciplined approach regardless of market conditions. We like research-driven, we like grounded in academia. We believe in a globally diversified portfolio while remaining cost-conscious. We want to have a goals-based portfolio to engineer your long-term success as an investor. And then finally, we have a dual risk mandate, which means that both willingness and ability to take risk for our investors, willingness being a more traditional risk tolerance, and ability being what we determine after the completion of a comprehensive financial plan, which we do for all of our clients that we make money for. We believe in that dual risk mandate for our clients when determining their asset allocation overall. So diving into actual market summary, it was another very good quarter. I would say that in my last couple of presentations, I've complained a little bit that while we always like markets going up, it's made it a little bit hard to find interesting things to talk about in these meetings. In some instances, not too much different. The S&P 500 hit new record highs again, which it's done effectively every quarter for the past year and a half. While tech-heavy NASDAQ, which this was new, did lag the broader market. So those magnificent 7 large tech companies underperformed the rest of the S&P 500 for this quarter, which is a little bit new. Overall, the gains that we've seen came amid a spike in volatility. It had been very slow, very steady, very few trading days that were 2% or more up or down. We did see a renewed spike in volatility this past quarter, at least on an intraday basis, that we hadn't seen since the pandemic. Probably the biggest news, I don't know why I put it third in my bullet points, but the Fed decided to lower their interest rates by a half percentage point. That is something we've been waiting on and talking about for quite a long time. Also, the first time that's happened since 2020, just like the spike in volatility. Treasuries extended their longest monthly winning streak in 3 years. Treasuries had another positive month. That's now 5 months in a row that prices for treasuries have increased. And then finally, the 10-year Treasury rate rose above the 2-year Treasury rate, which is important because since July of 2022, we've been in an abnormal condition, and that's a very long time for an abnormal market condition, in what's called a yield curve inversion. Generally, as an investor, you're supposed to be getting paid more the longer you choose to lend out your money. long-term rates are supposed to be higher than short-term rates. That has not been the case for the last 26, 27 months or so. But just finally this past quarter, really just last month, the 10-year rose back above the 2-year mark, ending the yield curve inversion. Looking at some of the headlines around world stock market performance, what we're looking at here is the MSCI All Country World Index with just some selected headlines that we saw from the third quarter. Overall, the global stock market, so this All Country World Index is a market cap weighted, including all countries, all markets, returned 7% for the quarter. This includes an 8%, 8.5% slide end of July into early August, which is the only time period that we really saw some notable events. Any of the market volatility we saw outside of that, they try to throw a headline to it. They try and throw world events that are going, but it very rarely translates to actual market volatility. But through the end of July into early August, we did have a couple notable events that seemed like it was very likely they were contributing to market performance. One of them was pretty direct. The underwhelming earnings reports that we saw at the end of July and into early August did lead to the NASDAQ into correction territory. At one point in time, it slid even further than 8.5%. It slid past 10. That was just from all of these companies that have gotten so big, their expectations for earnings are so great that a lot of times, even when they were just matching or slightly beating those expectations, the market still reacted negatively and some of those names started to sell off. So that was a pretty direct reason behind some of the volatility we saw. Secondly, you may have heard quite a bit about this, but there was renewed speculation that the Bank of Japan would start to tighten their monetary policy, kind of in the opposite of what the United States and Europe are doing right now, possibly start to raise their rates. And this led to the phenomenon known as the Japanese carry trade started to get unwound by some of the major institutions that invest on their behalf. So what that is that the Bank of Japan has had very low to negative rates for years. From a speculative trading perspective, there are institutions that wanted to borrow money in Japan and take those proceeds and go buy assets somewhere else. So as a carry trade, hey, rates are really low in Japan. Maybe they're higher somewhere else. If they think that they can create outperformance over whatever changes in currencies would happen between the yen and anything else, there's a speculative trade that institutions have had in place for a number of years now. When we started to see speculation that the Bank of Japan was going to tighten monetary policy, they were going to start increasing their rates. The belief was that a lot of those institutions started unwinding all of those trades and all at once getting out. Right about the same time that those underwhelming earnings reports were hitting tech, it created a noticeable shift in markets. So still a very good quarter. We still saw similar performance that we've seen for the past couple of quarters. But if you look between just day 1 and day 90 of the quarter, there was a little more volatility than we've seen the past couple of quarters and led to some interesting headlines for sure. Looking back a little bit further with our long-term market summary, and this hasn't really changed much. Markets are drastically outperforming their long-term averages, at least as we look within the last year over a trailing 12-month perspective, year-to-date perspective. The U.S. is the only one of these major markets that is outperforming its long-term average. If you go back to 1950, that long-term average is about 11.5%. Where U.S. markets on a 1-year, 5-year, 10-year basis across the board outperforming the long-term average, which is about 11.5% for U.S. markets. All of the other major markets are well above their long-term averages in the last year, in the last trailing 12 months, but all are also lagging their long-term performance when you compare it from a 5-year perspective and a 10-year perspective. So what that looks like is, our international developed stocks have returned 25% over the last year. International developed stocks have since 1970 returned about 9% a year. So for the last year, we're looking well above the long-term averages. 5 years, slightly lagging. uh, at 8.36%. And from a 10-year perspective, I would go as far as to say drastically underperforming with less than a 6% return. Some of these major markets, the data is tracked a little bit different than it is in the US. So they don't all have consistent timeframes necessarily. Looking at that a little bit further, emerging markets, data's been tracked since about 1988. As it's reported today, that's the most recent of all of our major markets. Emerging markets have returned about 11% since 1988. Looking great over the last year, up over 26%. 5 years, 5.75, 10 years, 4%, both drastically underperforming those long-term averages. And it goes the same across the board. Story is the same. Last year, looking great for all these asset classes, still have some work to do in the next couple of years to help right the ship on their 5 and 10 year averages overall. Now that we've gotten past our broad markets, looking a little bit more into the economy itself. So after a sluggish start to the year, U.S. economy accelerated during the second quarter, growing at about a 3% annualized pace. While inventory accumulation was a large contributor, the underlying demand was robust overall, and consumer spending has just continued to rise, and it rose overall by a pretty impressive 2.8%. Not all signals are green if we're looking at, hey, are we going to go into a recession? Are we not going to go into a recession? Not all signals are perfectly green with our economic indicators. If you see any of the talking heads or any of the detractors that are convinced that we're still heading towards a recession no matter what, generally what they're going to point to, our PMIs, employment indicators, some of these things have begun to slow, sparking fears that the economy, may still be closing in on a recession. However, one thing that is generally needed to lead to a bubble, to lead to a recession, is that there needs to be more or less excess built across these cyclical sectors in our economy. And there really just aren't many excesses in our cyclical sectors right now. It makes it seem like a recession is still pretty unlikely. This slide is designed to assess the health of the economy by looking at some of those key cyclical sectors, including residential investment, business fixed investment, light vehicle sales, and then the business inventory to sales ratio. These are often referred to as the four horsemen of a recession, because across these cyclical economic sectors, there's usually one or more that becomes overextended, which kind of suggests or leads to a bubble, which then, precipitates a recession overall. Like all of that would be forming if one of these indicators was out of place. And across the board, they're very close or within normal bounds of their long-term averages. Maybe business fixed investment as a percentage of GDP is a little bit high after bouncing off the average, but it's nothing to an excessive degree relative to what we've seen in previous years or previous recessions. So nothing here really looks overextended. Residential investment, vehicle sales are right at near average levels. What those would mean is that, excessive home building is not an issue. That was one that really led to problems, and starting in 2007, that culminated through 2009 with the great financial crisis. Consumers are in decent shape. When we're looking at the balance sheets of consumers, we spend a lot of time talking about the balance sheet of companies, but consumers themselves are in great shape as well. And then business spending is still in check. There's some recent enthusiasm around AI, and that has led to more business investment, even with the rate environment that we're in right now. But they're not accumulating excessive amounts of inventory. So nothing really overextended on the sectors. Always a risk. What we still do have is there's always the risk of outside shocks that could push us more towards a recession. We will talk about the U.S. election. It always creates uncertainty. Monetary policy is at a pretty critical turning point with are rates going to continue to fall to the rate that they have with our most recent rate reduction? Are things going to stall? Is inflation going to return? So there's always these outside risks. But I mean, overall, those risks do seem to remain low. If it seems if we were to reverse, we were to somehow tip into a recession, I mean, that seems unlikely, but even if we were to, all of these things would point to a mild recession. Not all recessions are necessarily created equal. Looking at labor, in the past we've talked about supplies, so this is looking at things on the flip side from a labor demand perspective. Coming out of the pandemic, strong demand for labor kind of clashed with a limited supply of workers, and it created one of the tightest labor markets we've ever seen. What our slide here shows is that labor demand has largely normalized from its post-pandemic boom, clearly off trend when we're hitting peaks in March 2022 of where the demand for labor is based off of our job openings. It's dropped back to a point where it's relatively on trend from where it was prior to the pandemic. The one way that we gauge labor demand is examining job openings. So this takes a look at, hey, how many job listings, job openings, how many positions are employers looking to fill? Peaked at 12.2 million in March of 2022, which is our outlier high point here. And right now sits at about 7.7 million job openings. We're lagging that data. That's as of the end of July 2024. And so what that means is that there's about one job for every one unemployed worker in the United States right now. We had seen points in 2022 where that number was as close to two. There were two jobs for every person looking for it. That slowly ticked back down to the point where technically on paper, there's one unemployed person per job available right now, which is a pretty good place to be at. What we have in the top right side is quits. So quits have normalized also as the loosening labor market conditions have seemingly made employees more wary about leaving their jobs. The data is softening, and overall it suggests that the labor market is still on solid footing. People are wary of quitting their jobs right now. So obviously there's some concerns out in the job market, but for the most part, it's still all within reasonable bounds. And then lastly, on the bottom right, we have layoffs. Layoffs remain historically low. Initial claims for unemployment benefits have settled down. That saw a little bit of a peak just because of some of the disruptive weather conditions we've had, some auto plant shutdowns, things like that caused them to spike through the summer. But in fact, overall, they're really the initial claims for unemployment are lower than they've been for more than 80% of the time this century. So still very low historically. Overall, labor demand has normalized. It hasn't deteriorated to the point of concern. Job openings are still a little bit higher than in any month prior to the pandemic. Subdued layoffs. I mean, all of this just indicates that businesses have enough confidence in their current prospects that they're looking to retain their workforce. Certainly this is all softer than it was relative to the past 2 years, but the labor market still looks very healthy, resilient for economic growth in the coming quarters, and it overall should facilitate plenty of hiring. Plenty of hiring comes with, well, what's the impact of all that's going to be on our total unemployment rate, on total wages? And within that broader labor market mosaic, investors have found themselves paying particular attention to, one measure as it pertains to all, and that's the unemployment rate. We reached a cycle low of 3.4% in April of 2023. Since then, unemployment has steadily ticked higher, reaching 4.3% in July before slightly easing again in August. And while all of this is still lower than it has been 88% of the time over the last 50 years, so just absolutely very historic low rates of unemployment, even if the current rate has ticked up a little bit from where it was. But, with unemployment still jumping, even if when you look back over the last 50 years, it hardly looks like a blip, we could still consider it, the unemployment rate jumping to 4.3%. Why this started coming up in the news a lot was of all of the ways to consider or try to predict whether we're in a recession or not, there's something called the Sahm rule. And the Sahm rule states that if unemployment rate's 3-month moving average exceeds its prior 12-month low by 0.5%, then a recession might already be underway. So while the last 6 months or so of increasing unemployment doesn't look like very much when you look at it in the context of like we have it here since 1973, it is enough of a change in that rate to trigger what is historically used as a measure for evaluating if we are in a recession or not, called the Somme roll. It's increased enough for that. Overall, though, the increase in unemployment, due to layoffs, would be if this was an increase in unemployment due to layoffs, it would be concerning, but that doesn't really seem to be the case, as we looked at on our last slide. The layoffs, the initial jobless claims, they're all still historically low. So this hasn't been the case for us at this point in time. Instead, what has been happening, the trend higher in unemployment likely just reflects a normalization of the labor market. We were seemingly operating above full employment for a period of time, as opposed to something, more concerning. And it's an adjustment back to a normal, healthy labor market. Nonetheless, looking at all of this in context, the loosening labor market slack has also led to wage growth. Recently, that wage growth has been moderated quite a bit. But wage growth peaked at 7%. The wage growth is the blue on our chart here. Wage growth peaked at 7% in March of 2022 in an attempt to keep up with inflation, even if it was lagging inflation a little bit. And that growth has continued to slow back down to trend. Wages rose a little over 4%, 4.1% year over year in August, which is just above the 50-year average of 3.9%. So this is likely slightly above what is consistent with the Federal Reserve's 2% inflation target. Wages are an important component of inflation. But overall, that softening labor market conditions should help wage growth ease, bringing inflation back down a little bit, where all of these things are very well intertwined. And then lastly, we'll wrap up our economic session by talking more about CPI. We've talked about each quarter for the past 18 months that all of these conversations we've had started with inflation, which is inflation got high. That's why we started, the Federal Reserve started raising rates to begin with. In order for them to feel comfortable to start dropping rates again, they needed to see significant improvement in inflation. So this whole conversation we've been having since the beginning of 2022, really, it started with inflation and ends with inflation. But after, kind of a bumpy start to the year, inflation has made meaningful progress lower in the past couple of months since we last presented on this. Giving the Federal Reserve the greater confidence that they needed, that it's on a sustainable path back to 2%. Those disinflationary tailwinds remained intact during the third quarter. Headline CPI inflation fell to 2.5% year over year in August, which is the lowest print that they've had since early 2021. Core goods, those prices have trended lower for the 6 consecutive months. Those are largely supply chain driven. So what was a big issue during the pandemic was the disruption of supply chains. Since the end of the pandemic, since all of these businesses have reopened, supply chains have remained pretty well managed. Even with some of the elevated geopolitical tensions, we got over a pandemic and we got into what were potentially some new global conflicts. Supply chains have remained well managed even with that. And overall, it doesn't seem like there's any more potential disruptions for supply chains overall. On the more volatile components, gasoline prices have stayed low throughout the summer, which has weighed on energy prices overall. That's helped there. Food inflation has remained mild. Moving forward, it seems like there's going to be a little bit sluggish global demand, and it's got a limited likelihood of a surge in either of those categories. But particularly from an energy perspective, escalating global conflicts could change that quite a bit. But as of right now, those prices have been actually lower, detracting from inflation, as you can see here. and doesn't seem to be significant changes in that going forward. That brings us, those are the easy parts. Some of the more difficult parts, some of the stickier segments of inflation, which have been shelter, which have been auto insurance. Shelter accounts for over a third of the total CPI basket and has been very stubborn in remaining above its pre-pandemic trend. Real-time measures of market rent that aren't lagging to the degree that the data here is, the official posted data, real-time measures seem to point to more normal levels of shelter inflation ahead. Auto insurance has eased a little bit, but it's still rising 16% year over year. We see that a lot when we talk budgets with our clients and their financial plan. I mean, auto insurance, home insurance, those have been very, very difficult to find any cost savings in over the past year, over the past 2 years. The one thing for auto insurance is a lot of the increase in auto insurance was being pushed by the increase in vehicle prices overall. Those have had a considerable lag effect since the pandemic, with prices going up quite a bit because it's been harder and harder for auto manufacturers to get cars off the lots while they're, sitting there 99.9% completed, with the exception of a handful of microchips, that we've seen, stuff like that. It does seem like there's starting to be a rollover in vehicle prices, which will feed through the data, feed through to auto insurance eventually, and then hopefully the trend lower should continue there. But overall, by all indications, inflation should continue to ease into 2025. Price gains in shelter and auto insurance very much still remain high. The real-time data suggests that hopefully there's some easing of those prices ahead. We'll continue to monitor it. And then overall, with broader disinflationary tailwinds, prices are still going to go up, but we would just like for them to go up at a lower degree. Some of those easy wage pressures that we just talked about, the stable supply chains, it's very possible inflation could reach the Federal Reserve's 2% target. It's a little bit possible it could reach there by the end of the year, but hopefully by 2025 or at some point in early 2025, we'll see a turnover and start to have expectations in line with the Federal Reserve for their 2% target. Moving past our overall economy, fixed income markets in particular are so intertwined with the economy. Looking at interest rate expectations. So here's where we are finally seeing some substantial changes that we've been waiting on, and that is Federal Reserve is finally cutting rates. So a little bit of a timeline through last quarter of where that put us. So with inflation on the steady path back to 2%, the Federal Reserve had turned its focus more or less back to the employment side of its dual mandate. The Federal Reserve's purpose is to manage inflation, manage employment where they can through monetary policy from the United States. At the Jackson Hole Economic Symposium, the Fed Chair Powell noted that they don't seek, his exact words, they don't seek or welcome further cooling in labor market conditions, which is what really started to open the door for the Fed to join these other global central banks in starting to ease policy. They've been very stubborn about, after raising rates very quickly, they've been stubborn about holding them there for a period of time as well. At the September meeting, so just within the last month and a half, the Federal Reserve finally did opt to kick off its rate cutting cycle with a half a point rate cut, which was a little bit surprising to some. I even think personally, I thought they were going to start with half of that, with 25 basis points, but they opted to kick off the rate cutting cycle with a 50 basis point, 1/2 of 1% point cut. That brought the range down to 4.75 to 5%. Some may see that larger move as a sign that the Fed is concerned about the economy. The downside to the Fed keeping rates higher for longer is that it increases the risks of potentially pushing the economy into a recession. But along with those rate changes, the Federal Reserve also publishes their economic projections, and in their economic projections, they still do predict a soft landing. And so there was no indication that they cut rates a little faster, coming in with a half point cut. There was no indication that they provided that they did that because they think a recession is looming or anything like that. What we can also see on our chart here is over the next 4 years, the committee expects steady growth of 2%, so 2% GDP. They do expect unemployment rate forecasts to, they increased their unemployment rate forecasts slightly, 40 basis points for the end of 2024, 20 basis points for the end of 2025. So they do think that an uptick in unemployment is possible, but just very, very small degree. And then overall, their inflation forecasts to go along with that, with all of those same time periods, 24, 25, all moved lower. So with an eye on the labor market, the Fed pulled forward rate cuts in its updated dot plot, which we're looking at here, with the expectation of possibly 2 more cuts for this year and 4 cuts in 2025. That would take what's called the neutral federal funds rate. So, hey, if they raise rates really fast, we're in the process of bringing them back down. Where does the Fed see it ending? That's what we call the neutral Fed funds rate. Right now, it's priced in at 2.9%. So just about 3% is where it's expected, at least from what they're signaling, of where their short-term rate will stop. We are not returning to the 0% environment for the foreseeable future like we had from 2018 to 2015, which notably stands out at the bottom of the chart. But if they do truly land this soft landing, they get inflation under control, they avoid a recession, they feel that a 3% neutral rate gives them the flexibility. If we were to get surprised with a recession in the future, it gives them the ability to cut rates further from there if they need to stimulate economic activity. So overall, the other side of this is, well, what are market expectations? There's a lot of participants in these interest rate markets that might disagree with what the Fed is saying. As of right now, market expectations are a little bit more dovish compared to the Fed's forecast, where they don't think that the rates are going to be cut as fast overall. There could be some moderate rising of interest rates from here, particularly if those rate cuts fail to materialize. The Fed may tell us that there's going to be 4 cuts next year, but it seems like some of the market participants aren't quite sold on that, and they think there could be 3 cuts or there could be 4 cuts, but to a lesser degree. So, nonetheless, with all of this, the long-awaited rate cutting cycle is finally here. The pace of the cuts hinges on continuing to monitor the incoming data. It seems like interest rates should settle at a structurally higher level compared to the last decade if we're getting to that neutral rate of 3%. But again, the one thing that could cause a hiccup and where that neutral rate is, of course, all of this is barring any economic shocks. If we start swinging towards a recession, we'd fully expect the Federal Reserve to cut rates further than what their current 3% target is. And with how that plays through to fixed income valuations, we looked at a few different iterations of this the past couple quarters. Even with rates starting to fall, bonds are still an attractive place to be. Bonds rallied over 5% during the third quarter, as we saw some of that cooling economic data, the dovish Fed commentary. All of this caused markets to double down on rate cut bets. Even after this rally, yields across many fixed income sectors still look attractive relative to recent history. So this is if rates were just to hold for the foreseeable future where they are today, and the only return we were getting from our fixed income was the yield or the coupons that it was paying. In that environment, we are still earning more on average than we would have historically relative for all of these fixed income sectors. The other part of the price equation or the return equation in fixed income is rate movements. If rates were to continue to fall, you see price appreciation in your bonds as well as getting these same yields, which is what we'll kind of finalize more later. I've been harping on this for probably 12 months now. Like, now is a very good time to buy fixed income if you are heavy in cash, because you get these yields, you have the potential for price appreciation. But, all I say, this slide shows yields across fixed income sectors relative to the last 10 years, and nearly all sectors are trading above their 10-year median yields. So even simply sticking with core fixed income, high quality corporates, those can provide attractive yields of almost 5%. If you're leaning into riskier asset classes, something like high yield, still corporate, but much worse balance sheets, you can still provide yields of about 7%. Credit spreads across investment grade and high yield do look tight. That's just the spread of, hey, what's your high yield paying versus what your quality is paying. Generally, the wider that spread is, the more likely you are to want to buy a high yield, because as those spreads compress, you get more of a price return in your high yield. So historically, those spreads are a little bit tight, but not history doesn't always repeat itself perfectly, and the reason that it could still be attractive to invest a portion of your portfolio in something like high yield is that if they remain tight, it's only because corporate fundamentals are still in solid shape. We're in a trend-like growth environment. We're potentially avoiding a recession, where it's not a hard and fast rule in fixed income. You need to have wide credit spreads that you allow everything to fall apart from there and earn your price returns. Those tighter spreads shouldn't deter investors from making sure that their fixed income portfolio is diversified, taking advantage of those attractive all-in yields. And so while it's difficult to make any outsized bets on duration, we still like to remain relatively close or tracking with our bond benchmarks of the market cap weightings overall. So it's difficult to make outsized bets on duration. But overall, bonds should very much still help diversify a portfolio if lower rates would perhaps coincide with a recession. If that unlikely but still possible scenario exists where we have a mild recession, we see a sell-off in our equity markets, the makeup of the fixed income market today is still very attractive to allow for this fixed income to diversify portfolios in the event of something like a recession. Even if the rates hold steady, like I mentioned earlier, even if rates hold steady, we're getting attractive yields, attractive income, even if there is no potential for price appreciation, which there largely wouldn't be if rates held steady. So overall, as the Fed continues to move deeper into its rate cutting cycle, the potential for asymmetric returns in bonds starts to fade a little bit. If rates fall to the point where it's equally likely that rates rise by 1% or fall by 1%, we stop seeing those asymmetric returns that we have today. As of right now, it appears that rates can hold, they can fall. The chance of them rising again is not incredibly likely, at least not with Fed actions. And so it's, important to lock in some of these attractive levels of income while they're here. That's a conversation we're having with our clients quite a bit. So moving beyond fixed income into our equity markets. So finally, I've seen a little bit of a change in this. We've talked a lot about those large, magnificent seven companies in U.S. markets and having a greater and greater share of our markets and the contributions to returns. We've seen in some areas a little bit of deviation here, but not as extremely as we might have liked. But the overall U.S. market has been resilient in 2024. We've had impressive returns. Despite repricing and policy expectations for the Fed, and stocks had shown in a few point periods of time few signs of slowing. S&P 500 is up 15% this year, and what we have here on the left side is that the rally has remained slightly narrow in nature, with the Magnificent Seven continuing to lead the charge higher. So on the left-hand side is the top 10 companies in the S&P 500, and relative to the remaining stocks there and averaging out to the S&P 500 overall. What largely from a price perspective. So based off of multiple price to earnings, what are these companies trading at? So those Magnificent Seven are up 30% for the year. Rest of the index is up 5. Um, and the strong performance for those companies isn't without reason. They're large beneficiaries of the excitement around artificial intelligence. Um, and they were responsible for all of the S&P 500's earnings growth in 2023. But what we're starting to see is that, at least on the bottom right hand side, the dynamics of our economy are changing a little bit, and so all of those companies with the free cash flow and how they translate that to their R&D budgets overall, that it's creating companies that have wider and wider moats over their competitors. And it seems to show performance with reason. What is one main detractor still that I mentioned at the very beginning of the webcast that we're wanting to be mindful of is that with the price to earnings ratio still being so high for these companies, even if it's come down a little bit, as shown on the left side of the screen here, it gets really hard, even for great companies with great cash flows, to keep up with the expectations of earnings growth. Where from a price perspective, what that can mean is meeting expectations still not being enough for market participants. And even though they're releasing guidance of what they think their earnings are going to be from the next quarter, people can invest in the company based off of that. They can release their earnings and be right in line with their own expectations, and market participants can still be disappointed in it, and it can lead to prices falling off and returns falling short. That is what we want from a diversification standpoint to be mindful of when we allow too much of our portfolio to be allocated in just absolutely the Magnificent Seven, those largest 7 stocks. The top 10 of the S&P 500 overall is just continuing to allow for the diversification. At some point in time, they're going to fall short of expectations. And with 36% of the top 10 stocks, with 36% of the S&P 500 being in those top 10 stocks, you very much feel the impact on your portfolio when you have market weight allocations to them. Expanding out and focusing a little bit more globally, there has been a very long cycle of U.S. equity market outperformance over international markets, and that has left many U.S.-based investors nervous about allocating abroad. We're guilty of that as well. We have been underweight internationals relative to their market capitalization. The story just hasn't been as attractive there lately being the past 10 years or so. But at this point in time, there do appear to be very attractive fundamental tailwinds around the world that are, they're hard to ignore because they're just so much different than what we're seeing in the United States. Over half of the 50 top performing companies this year, equity-wise, are located outside of the United States. So what this slide looks to do is kind of highlight opportunities that investors may be missing. There's earnings growth. There's U.S. has been outstanding market in earnings growth, but the prospects in other countries are absolutely improving. For example, there's been higher wage growth in Japan that could create a positive wage price spiral. That could boost company revenues. It could improve Japan's economy, which has been a little bit sleepy, despite the lower rates that we talked about. Moreover, there's continued focus on improving corporate governance, and all of these things could generate additional multiple expansion, so additional growth and values. Looking at Europe, they're stabilizing their manufacturing activity. All of that is improving the economic backdrop and should translate into supporting corporate earnings as well. In China, it appears that peak pessimism is behind us. Overall emerging market earnings estimates have improved on the backs of the AI tailwinds, optimism for a turn in the electronic cycle. Strong performance across international markets has pushed valuations higher over the past 6 months. But even with those valuations getting higher over the last 6 months, in both absolute terms and relative to their own histories, international markets are way more attractively priced compared to the US. Just looking at the multiple of price per earnings that you're paying for those companies, that you're paying for those cash flows, considerably more attractive in the US. And, importantly, given that some global central banks have begun easing policy while the Fed has slowed a little bit, the strong US dollar could weigh on returns for US based investors. So, still very favorable valuations, improving economic backdrop, and positive fundamentals. All of these things are important to highlight around the globe, that we are seeing a lot of green. There's favorable outcomes or favorable markets in both developed and emerging markets overall. Kind of finally, what that translates to is on the right-hand side in particular, the difference in dividend yields in the United States relative to the rest of the world. So, we have, as it stands right now, there's almost 2 standard deviations of higher dividend returns in international relative to the dividends that are being paid by U.S. stocks. That is translates to almost 1.7% more dividend yield that we see internationally than we see relative to U.S. stocks. And then on the left-hand side is that price to earnings discount. When I forgot to advance my slide fast enough when I was talking to price to earnings discounts, is on the exact flip side of that. So 2 standard deviations, 36% lower on price to earnings discounts abroad relative to those same U.S. companies. So you can buy these companies for a more attractive value. They pay you more on the back end as well. All of that seems very nice. It doesn't change the fact that even with that, internationals have underperformed the U.S. quite a bit in the last 10 years. But looking forward, knowing that the next 10 years looking anything like the last 10 years from an entirely macroeconomic standpoint is so unlikely. Very much a circumstance where, past performance is not a guarantee or necessarily an indicator of future returns. There's a lot that's looking pretty attractive in those international markets right now. So lastly, we'll close it out. The one major event that we have coming up that we haven't talked about much yet is our upcoming election, and what it means to invest during elections. So overall, it's very natural for investors to look for a connection between who wins the White House and which way stocks will go. Regardless of who wins, nearly a century of market return shows that stocks have trended upwards regardless of who wins, regardless of political regimes. If you participate in the stock market by staying invested, given a long enough time frame, you've been rewarded. Shareholders, we are investing in companies. Those companies have a focus on serving their customers, growing their business, regardless of who's in the White House. U.S. presidents may have some impact on market returns. It's been difficult to measure in the past. But, even if presidents do have an impact on market returns, so do many other factors. The actions of foreign leaders, not just who we have domestically, interest rate changes, oil price changes, technological advances like AI. All of those, just to name a few, these are all factors that also very much weigh on and change financial markets. That makes who our president is or the makeup of our Congress just a small factor in what happens to stocks in the long run. Stocks have rewarded disciplined investors for decades through both Democratic and Republican presidencies. Another question that we get quite a bit is looking more so at the short to intermediate term. So what we have here is monthly volatility. the history of the stock market going back to 1926 shows that returns in months when presidential elections took place, they really don't reflect any consistent pattern. This is monthly market returns and the volatility of those returns going back to 1926, with the red dashes being a month, an election month where a Republican won, the blue dashes being the month where a Democrat won, and green being all of the very many non-election months overall. And so there's really no discernible trend on, even for clients that we've had that have been concerned about the month of November and said, hey, maybe I want to sit on the sidelines for this month, wait for the election, to work itself out. There really hasn't been any sort of pattern of increased volatility during election months. So, and all of these are in 1% increments. So, like left side being large market drops, right side being large market gains, with everything in between. Winning party hasn't been a reliable driver for the direction or magnitude of market movements. And, historically, behavior during election months makes a strong case for just sticking with your plan. Achieve your long-term goals. Don't let the 1 month volatility in the month of the election sway you from that. Zooming out just a little bit on that. Next, we have from the day after the election until Inauguration Day, which is about 2 months after the election. Of the 18 presidential election years since 1952, 9 of them saw market return that were positive on the first trading day following the election, which, if you're doing the math, tell you that 9 of them saw markets turn slightly negative on the first trading day following the election. We're 50-50 there. The average of all elections since 1952 was down 0.23%, which is an incredibly normal day. And I don't think there's anything to be kind of told of that just so happens to be the average post-election. The most positive reaction we've seen was up 2.2% in the 2020 election. The most negative market reaction we saw was down 5% in the 2008 election. And just looking at what we've had recently, 1% the day after after President Trump was elected, up 2% the day after President Biden was elected. I will say, with the further makes this interesting, when Trump was elected, overnight, U.S. markets spiked close to 10%, where it made it seem like there was this, huge bid of, this was a surprise election. This is going to be great for business. This is going to be great for markets. But it was difficult to act on it at all. By the time markets opened the next day, and from a cycle of when they opened to where they actually closed, all of that overnight pop was effectively eliminated. It was a little bit over a 1.1% gain. So even when there are these potential big shocks, if it's overnight and if it's right after the election is called, the chances of it actually impacting markets when they're open and traders have anything to do with it is further unlikely. But then again, 2 months after election day, it's largely positive. The worst negative market reaction 2 months after election day was down almost 20% from November of 2008 to January of 2009. I think it's very fair to say, regardless of your political affiliation, there was a lot going on in our economy that probably had more to do with that than who was elected and wasn't even in office at that point in time, which just further shows that it's tough to take all of these past elections and say, oh, I'm just going to choose not to invest for through Inauguration Day because I don't want to deal with the volatility, don't want to deal with the uncertainty. It's generally economic events that determine this a lot more. And then lastly, from the most extreme standpoint, is really, really don't want to make a habit of only investing when your preferred party is in office versus staying invested overall. The outcome is substantial. So what we're looking at here is going back to 1950. If you only invested in the S&P 500 during Republican presidencies, you'd have a 2.78% annualized return. That would translate to 78,000 or so in final investable assets. If you only invested during Democratic presidencies since 1950, slightly higher return, 5.2% annualized return, 445,000 in final investable dollars. And if you invested during all presidencies, regardless if it was your preferred presidency, you'd have a higher annualized return, over 8%. And your final investment value would be $3.46 million relative to 445 or 78,000. There's no reason, whether it's long-term, mid-term, or short-term, to make changes based off of your preferred party for the election or who you are voting for. It tends to just not work out well for investors. All of the data would suggest that, yes, elections are important. They do help drive the future of our country. But as it pertains to financial markets, there is a lot more that determines the success of financial markets than who is in office. Absolutely vote. Absolutely let your voice be heard. Just really wouldn't recommend changing your portfolio or your investment strategy based off of your belief of the upcoming election. So summarizing that all finally into our implications for investors, has always been want to avoid our common mistakes, trying to time the markets, focusing on headlines that we talked through. All of this is particularly amplified near elections. Avoid market timing, avoid headlines if you can, at least as it pertains to your market portfolio, particularly near elections. Maintain a systematic approach. So particularly on the equity side, just because we are near all-time highs in equity markets, it is no reason to make changes to the approach. Systematic trading and systematic rebalancing, absolutely, that's one thing. If you have the ability to take risk and the tolerance to take risk that matches you with a 70% stock, 30% bond portfolio, and because markets have gone up, next thing you know, you're at an 80-20, yeah, by all means, systematically sell when things are high, buy when things are low, and return yourself to a 70-30 portfolio. But refusing to invest because we're at or near all-time highs is not a sound strategy. And then lastly, like I said, I've been harping on this for a little while. I think it's a stronger point now than ever, considering we are actually in a rate cutting cycle now. But have a plan for your cash and when to put it back to work. We've had money market yields that were really attractive for the last 18 months to almost 2 years. They were nice while we had them. Still a lot of other asset classes that were returning more, but hey, cash is cash, money markets are money market. That more or less free ride has started to come to an end where those yields will only continue to fall as the Fed cuts rates. We talked about the merits of all of these other extended sectors of our fixed income market, and the yields that they have today that they would continue to have for longer, even if rates do fall. And so absolutely, if you make one change based off of all of this, evaluate your cash and money market CD positions, keep only what you really need in there for short-term obligations, and consider the rest of the fixed income universe for the remainder. So that is it for our presentation today. We appreciate you joining us for our call. Please reach out to us for more information if you have questions. All of this tends to be so specific for each person, for each investor, for each financial plan. We have no choice but to talk in generalities during these presentations, but if anything we discussed here, piques your interest as it pertains to you and your financial plan, please don't hesitate to reach out. You can call the office. You can shoot us an email. We are here to help. Jim, as the last piece, did we have any questions that came through on the chat? I don't think we did. Well, like I said, everyone, thanks for joining us today. If you tuned in late, we will have a recording available within the next week or so. Please just let us know if you'd like to see it. And we look forward to catching up with you at our next market review, where we get to review the end of 2024. So reach out to us if you have any questions, and thank you so much for your time today.